50 Tesla puts, $20 out of the money, back in like January. And I only meant to buy 5, and I didn't mean to buy them out of the money. So I bought the wrong strike. I bought the wrong option, and I bought 50 of them instead of 5 of them. And then they went in the money, which was super. I mean, the whole thing was just a comedy of errors. It would be like in baseball if an outfielder like made an error and nobody scored a run. Like the bases were loaded, but nobody scored a run. Like just absolute nonsense. Yep, I mean owning Palantir continues to be a ongoing embarrassment. That was me who asked. I didn't get angry or dislike the video. I'm still here. Thanks, Gary. Where's Moonwind? Who gives a shit? Does GME move additionally to the SPY movement? Multiply the other direction at the moment? I forgot the term for it. Yes, a bit. The lower range. So as we approach the gamma flip point, price action will accelerate with indexes. And then obviously if we cross it, it'll continue to accelerate. This is what they want to prevent. They don't want this because this spikes IV. But yes, our beta is quite high right now. So our sensitivity to index improvement is high. That's because so when gamma is net negative, right? We're under the gamma flip point. The MM and active funds are both buying the stock together, which puts a lot of pressure on the DMM to internalize, right? Because they don't want the price breaking out. They don't want volatility. And so they have to internalize more because both funds are buying. Versus, if gamma is positive, so if we're up here in this range, then the MM is selling into rising prices, buying into falling prices, which means that the DMM doesn't need to internalize as much in order to stabilize volatility. Does that make sense? Or am I just like talking to myself? So up here, MM sells into rising prices, buys into falling prices. So you have much less volatility, but far more stability, right? And then under here, the MM buys into rising prices and sells into falling prices, which gives you lots of volatility. So stability, stable, volatile. And right now we're here. It has to do with dealer positioning. I feel like it was a great explanation, but I know it's hard to understand. It's really complex because you start to get like further and further out from the actual derivative, right? Because you've got the market maker, and then you've got the market maker's positioning, and then you've got the market maker's exposure to delta, and then how their exposure to gamma affects their exposure to delta, right? So it's I get how confusing it is. Well, the DMM does the internalizing on NYSE. On NASDAQ, they have internalizers. Works a little different because of the automated DMM. Have you guys made equations with variables for all this stuff? I mean, we have stuff. Yeah, we've got things. We're cool. Is this gamma flip point one of the Greeks you post? Delta neutral? No, not really. Gamma flip has more to do with the current structure of gamma in the options chain and how it's skew adjusted. Delta neutrals are just like, or Greek neutrals are just, the neutral point for that value. So the benefit of delta neutral, gamma neutral, is they're going to hedge against those neutral positions, right? If they want their portfolio of whether they're selling options or they're buying calls, or depending on their positioning, those Greek neutral values tell them where they need to hedge to. So those kind of give us an idea of where the hedge will go for different positions to reach their neutral values. So like when gamma flips, the market maker needs the price to move up to gamma max so that gamma can collapse, right? because when gamma flips, they have to start selling calls, right? Because there are call buyers, which makes the market maker short calls, right? And they need gamma to flip so people sell those calls so they can become long calls. And so like when price starts accelerating the upside into that gamma max point, gamma expands and becomes harder and harder to hedge. So you get more and more volume and more volatility until it reaches gamma max or surpasses it, depending on how much interest there is in the stock at the time. And then when it crosses gamma max, the expansion of gamma collapses and the price falls. So like you can't really have a run that's sustained unless one of two things, that once it crosses gamma max. So once you cross gamma max, the run can only be sustained by gamma max rising above it. So usually on a run, gamma max kind of has a start point, and then people buy more and more out of the money calls, which increases gamma max, right? But also as this is happening, call prices go up. Okay. So call prices are constantly increasing, and the amount of money or capital required, like, it gets thick. It makes thick in the warm because it takes so much capital to move gamma max up further, the higher and higher it goes, right? And so, price is here kind of rising up. And then once price does cross gamma max, a run really can't be sustained beyond this point, right? Because, call side can no longer buy more calls to continue raising gamma max. So they begin to capitulate, which flips the market maker hedge to net long calls, which means the market maker starts selling into the price. And then, price falls. Make sense? Clip? Okay.